Welcome to Wisdom Planet, wisdom worth spreading. Happy listening. The book I am going to interpret for you today is called Angel. One of Silicon Valley's most successful angel investors shares his rules for investing in startups. There are two ways to make money in startups: create something valuable or invest in the people that are creating valuable things. Why do we say that angel investors are specifically making big money? This is because they are a group of people who invest in early-stage startup companies. This type of investment carries extremely high risks, but once successful, the returns can far exceed more stable and mature investment tools such as bonds, gold, and index funds. For example, if you invested $1,000 in Apple when it first started in 1976, by 2018, that $1,000 would have turned into a massive fortune of around $15.2 billion. This is the kind of return that an angel investor may achieve. Of course, this situation is quite extreme, because in most cases, angel investors sell their shares in the startup company after holding them for 3 or 4 years. This is because if the startup company you invest in aligns with the market, then after 3 or 4 years, it should have grown enough to attract the favor of mainstream capital, such as going public or being acquired by a large company, and at that time, they no longer need the help of angel investors. From here, we can see the most unique aspect of angel investors, which is their ability to move with capital first and take the lead in occupying the market before mainstream capital enters. People say that capital is smart. By following the flow of capital, you can see the most efficient areas in the market and understand the ups and downs of the economy. However, in order for angel investors to succeed, they need to be even smarter than capital itself. They need to anticipate the anticipation of capital. Moreover, this kind of anticipation is not like the price predictions we make for traditional asset classes such as stocks and bonds, which mainly rely on data and model deductions. When making predictions, angel investors need to mobilize their industry instincts, experiential senses, and more. It can be said that every angel has their own secret method. The book we are going to discuss today aims to decode one representative set of these secret methods for you. The author of this book, Jason Calacanis, is one of the most famous angel investors in Silicon Valley and the first investment hunter hired by the top venture capital firm, Sequoia Capital. Before the publication of this book in July 2017, he had been an angel investor for only 6 years but already had a portfolio worth $150 million. Among his many investment cases, the most famous one is the online ride-hailing app, Uber. When he first started angel investing, he decisively invested $25,000 in Uber, which was valued at only $5 million at the time. Later, Uber experienced astonishing growth, bringing the author a return on investment of over 1,000 times. It was this investment that established his top position in the investment circle. In the book, the author meticulously breaks down almost every important milestone that an angel investor has to go through. Not only does he share his own personal experiences and practical knowledge, but he also interweaves many unknown inside stories of today's tech giants during their startup phase. In the following interpretation, we will divide it into 3 stages to see how the author went from a poor boy from Brooklyn, USA to a billionaire angel investor. In the first stage, we mainly look at how the author accumulated the initial capital for angel investment. In the second stage, we discuss how the author entered the angel investment circle and established their own network of contacts and resources. In the third stage, we examine the author's experiences in investment practice, with a focus on the key strategies they used in selecting investment projects. Part 1. Okay, now we are entering the first stage, the starting phase. We all know that in order to become an angel investor, you need to have capital to invest with. However, at the beginning of his career, the author, like most young people, was just a poor guy who had recently graduated from school. So, how did he manage to accumulate the initial funds to start angel investing? In the past, the author adopted a 2-pronged approach by first starting their own business and then becoming an investment consultant for startup companies. Their first entrepreneurial project was a magazine called Silicon Valley Report. With the advent of the internet era, this magazine also transformed into an online website that collects and publishes the latest trends in Silicon Valley, and was later acquired by the large company Dow Jones. This entrepreneurial experience lasted for nearly 7 years, but it did not bring the author much wealth. However, during this long period of hibernation, he accumulated a wealth of knowledge and connections related to technology entrepreneurship, as well as skills in marketing and public relations operations. It is precisely because of this that he was able to subsequently provide consulting services for multiple startup companies. Consultants do not need to invest money to become shareholders, but instead exchange their knowledge, skills, networks, or reputation for company shares. Before entering the angel investment field, the author has provided consulting services for a total of 6 companies, with just the first 3 providing a return of $700,000. At the same time, the author is continuing entrepreneurship and achieving good results. For example, the blog company, Weblogs Incorporated, that they co-founded was later acquired at a high price by AOL. During this long period of entrepreneurship and assisting startups, the author has accumulated a solid understanding of technology startups. Just like one can only possess discerning eyes after going through the alchemical furnace. This period of hibernation before entering the industry has also allowed him to more keenly perceive what kind of entrepreneurial projects can withstand the test of fire and be considered true gold in the future. However, at this point, the author says that if given the chance to go back and do it all over again, he would choose a different path. That path would be to directly enter the angel investment industry. Why? The explanation given by the author is that actually, in the 1980s, when he was around 20 years old, he had already had a lot of exposure and understanding of the computer field, and he knew clearly that companies like Microsoft and Cisco would grow into giants in the future. For example, he realized at that time that the transition from the widely used DOS system to Microsoft's Windows system would be a huge leap. The complex interface of the DOS system, filled with command line codes, actually turned computers into a secret club for a few people, while the graphical interface and mouse used by Windows could turn computers into a McDonald's for the masses. The author said that if he had put his insights into practice in the late 1980s, before Microsoft and Cisco went public, and invested a few $100s in these companies, he could have earned hundreds of thousands early on, and would not have needed the later arduous process of saving money. This may sound a bit like hindsight bias. However, the author wants to use their own experience of missing an opportunity to remind readers not to let so-called poverty limit their courage and stifle the potential profits that could belong to them. In their opinion, instead of spending hundreds of dollars each month on various TV packages or video memberships, it would be better to save that money and use it for project investments. Even if you only invest $500 in each company, after 5 years, you would have invested in at least a dozen companies, and perhaps one of them could bring returns hundreds or even thousands of times the initial investment. Even if that's not the case, such an experience can help you accumulate investment knowledge more directly and make connections with various entrepreneurs and investment partners earlier on. The author also points out that young people today have a greater advantage in searching for projects compared to when he was young. Because they don't even have to personally travel around, they just need to open their laptops and can invest together with other experienced angel investors. This was not possible a decade ago, but in the past few years, the United States has seen the emergence of many legitimate organizations specializing in angel syndicate investments. On the websites of these organizations, successful angel investors create syndicates where they introduce the sectors they typically invest in, the companies they have already invested in, the approximate amount of each investment, the percentage they receive upon successful exit of a project, and so on. Young people who have just entered the angel investment field only need to register on the website and join one or several syndicates that have been approved for investment evaluation, in order to provide a small amount of funding for each startup company approved by the syndicate. In addition, the author provides some suggestions on how to choose joint investment projects. He believes that investors should primarily focus on several project characteristics. Firstly, the leader of the joint investment group should have at least 5 years of investment experience and have invested in at least one well-known unicorn company, which refers to a startup company that has been established for no more than 10 years and has a valuation exceeding $1 billion but is not yet listed. Secondly, the startup company should have at least 2 founders so that if one of them exits in the future, the operation can still be maintained. Lastly, the startup company must have already launched a product or service and should not still be in the stage of mere talk on paper, and so on. In the author's view, angel investors participating in around 10 joint investment projects before formally entering the industry is not only for financial gains. It is also a process of expanding connections and establishing reputation. Part 2. After the initial stage, if you have accumulated a certain amount of capital and knowledge, it is time to leave the cozy bed of joint investment. Because the best projects are usually not publicly listed on these joint investment websites. You must independently screen investment projects, thoroughly investigate companies, and meet with investors. According to the author's estimation, an angel investor needs to evaluate over 10,000 startup projects and have discussions with thousands of founders within a span of 10 years in order to find around 200 projects for investment, and among these projects, only a few may succeed. This makes the entire process of screening investment projects similar to gold panning. You need to filter out a large amount of sediment and impurities in order to possibly find real gold. So, how should this be done? Let's imagine for a moment. If you want to maximize your success rate in gold mining, is the first thing you should do to pick up your tools and start working right where you are? It doesn't seem like it. The first thing you should do is determine which piece of land has the most gold mines, and then go there to start working. Doing angel investment is the same principle. You need to search for projects in the fertile ground of innovation and entrepreneurship, because it is here that the next unicorn company is most likely to be born. If it is in the United States, the author explicitly states that you must go to Silicon Valley. Because in the past 50 years, no place has brought more changes to the world than this small peninsula called Silicon Valley. The well-known super unicorns such as Google, Facebook, Apple, Twitter, Uber, LinkedIn, eBay, and others were all born in Silicon Valley. The most outstanding and promising tech talents and entrepreneurs often come to Silicon Valley. And if the best entrepreneurs come here, the best angel investors must also come here. So, after arriving at the gold rush holy land where opportunities abound, can we roll up our sleeves and show off our skills? Not yet. Because if we want to mine the gold buried underground, the power of a newcomer alone is not enough. Those hottest projects are usually quickly divided up by experienced veterans in the venture capital circle before you even know about them. Therefore, you must quickly squeeze into this circle and make use of the information and connections within the circle in order to access those most valuable mines. The author refers to this process as building a project sharing network. How to do it specifically? First, you need to take stock of the cooperative investors of those startup companies you have previously invested in and put them all in a spreadsheet. If you have already invested in 10 startup companies through joint investment websites, then you will have a potential reserve of 500 to 600 investors in your spreadsheet. Step 2. In your spreadsheet, write down the LinkedIn, Twitter, and Facebook links of these investors, and then add them as friends on these social platforms. Your friend request can say something like, "Hello Mr. So-and-so, I have also invested in XYZ startup company, just like you." This helps to create a sense of closeness. After that, you need to open the social platforms once or twice a day, like and interact with those investors who have added you as friends, to establish your presence. This is a simple yet effective process of distributing social currency. Through this process, you can build basic social relationships with these insiders. The third step is to selectively send emails to those investors who are most interested, inviting them to meet in person. During the meeting, you can focus on understanding the projects they have recently invested in, why they invested in these projects, and what kind of assistance they have provided to startup companies, etc. Additionally, don't forget to ask them about any interesting projects they are currently evaluating. You can even talk to them about a few projects you have recently invested in and ask if they are interested in meeting the founders as well. The author points out that every time you meet with other investors, you must always present yourself as if you are in an interview and show your best side. Because in today's society, capital is abundant, but good projects are hard to come by. Remember? We mentioned earlier that those truly good projects have already secured funding before everyone else knows about them. Therefore, you must perform well enough to convince experienced angel investors to introduce you to their precious projects. Once this door of trust is opened, you can start accumulating resources continuously and weaving a network of shared projects with other investors. Part 3. Once you have your own private project stream through project sharing network, the next step is to filter projects. First, you need to clarify the track you want to invest in, which is the industry where the project is located. In the author's view, there are only two types of industry tracks in the world. One is the type that expands crazily, and the other is the rest. The term crazy expansion mentioned here refers to the ability to achieve a valuation of billions of dollars and increase stock value by hundreds of times. The author points out that in traditional industries such as restaurants, movies, clothing factories, and distilleries, except for very few cases, it is difficult for founders to reach this level no matter how hard they work. You might say, but what about traditional companies like McDonald's, Starbucks, and Lululemon, which makes yoga apparel? They have already reached the level of billion-dollar giants. Yes. However, it is important to note that behind their massive size, there is a period of accumulation and growth that can last for decades. But the reality is that most of us cannot wait for 3 or 4 decades to slowly accumulate wealth. This is especially true for angel investors. What they are looking for are companies that can become giants within 5 to 10 years. And in this regard, information technology companies outperform traditional companies by far. Why? Behind this is a not complicated economic principle. What determines the expansion of a company's boundaries is the marginal revenue and marginal cost it brings with each unit of expansion. As long as the marginal revenue is greater than the marginal cost, the company will continue to expand until they are equal. The fundamental difference between traditional enterprises and information technology enterprises in their expansion lies in the different patterns of change in their respective marginal costs. You see, take McDonald's as an example. Its expansion method is to sell one more hamburger or open one more branch, and the costs of these are almost fixed. The cost of opening the 9th branch will not be much lower than the 8th. Looking at companies like Google and Uber, their expansion strategy is to get more people to use their software, and once the software is developed, the cost of adding each user is minimal. It is only when they reach a certain limit that they need to increase operational and maintenance investment, and then continue to expand. This is why the author suggests angel investors to focus on the information technology track, rather than traditional tracks. So, once we step onto this track, how should we select specific projects? The author tells us that what you should focus on is not the idea or the market, but the entrepreneur themselves. People do not represent everything, but they are the only criteria for judgment. This is a sentence that the author repeatedly emphasizes in his blog. No one can know whether a company will be successful in the future, but we can judge whether the person who founded this company can be successful. In order to make this judgment, we need to have a face-to-face interview with the entrepreneur. Imagine if right now there was an entrepreneur sitting in front of you. How would we determine if they have the potential to create the next Google, Facebook, or Uber? The author provides 4 key questions that can be asked to assess them. First question, what are you doing? This question sounds a bit like asking, what does your company do, or why should I invest in your company? However, these questions are essentially asking about things rather than people. We need to recognize that the key to Google's success lies not in being a company that develops information search engines, but in the fact that Google's 2 founders were able to create software that was superior to their competitors, helping people search for information more quickly. And if we ask entrepreneurs, what are you doing, we can better focus on the entrepreneurs themselves and what they can do or are doing. Second question, why do you want to do this project? After posing this question, you may hear a variety of answers. Here, the author reveals the 2 worst types of responses he has heard as an angel investor. The first type is for the sake of making money. The author points out that if a person starts a business solely for the purpose of making money, they are likely to give up in the end. Why is that? Just imagine, if you have the ability to develop a top-notch search engine, you would definitely need the skills of top programmers. And for someone with such abilities, if their only goal is to quickly fill their pockets, they could easily get hired by Google or Facebook. This way, they could directly receive stocks and salaries worth $1 million per year. In that case, why would they take on the huge risks, invest a lot of time and resources, and independently develop a software themselves? In short, if entrepreneurship is pursued with the sole purpose of making money, entrepreneurs will soon discover that there are many other avenues that can generate faster and greater profits in the short term. As a result, they no longer consider entrepreneurship as something that requires long-term commitment. The above is about the first type of terrible response. The second type of terrible response is because some successful company didn't do this feature. For example, after the author invested in Uber, there were always people recommending Uber for food delivery, Uber for sharing helicopters, Uber for shopping, and so on. The author believes that such entrepreneurs actually lack foresight because they choose to develop a supplementary function for other companies' products instead of creating a complete product or having a great mission. Even if these companies succeed temporarily, they usually end up being crushed by larger companies or being acquired at a low price, without the opportunity to become a unicorn. The above mentioned are two types of bad answers. So, how should we answer the question, why do you want to do this, correctly? The author tells us that it varies from person to person. For example, if you were to ask the two founders of Uber, they would tell you that their original motivation for starting their own business was simply because they couldn't find a taxi in Paris during a tech conference. Facebook's founder, Mark Zuckerberg, would tell you that he was afraid of socializing, not good at interacting with the opposite sex, and was too scared to contact his ex-girlfriend. So, he wanted to create a social platform where he could know everyone's social status. This may sound a bit simple and childish, but think about it carefully. Is there anything more important in the world than reproducing offspring? According to Darwin and Freud's theories, there isn't. Therefore, Zuckerberg's social anxiety disorder has created the fastest growing consumer product in human history. Third question, why now? The author believes that, in some aspects, this is the most important issue. Because in the field of scientific and technological innovation, there are always many people constantly repeating the same ideas. When we look at many internet giants now, there may always be a feeling they were able to rapidly expand because they were the first to occupy a certain track. But in fact, what many people don't know is that Facebook is the 10th social platform, Google is the 12th search engine, iPad is the 20th tablet computer, and YouTube is one of countless video websites. They were not the first players to enter the track, so why did they become the fastest and the best? Here, the author tells us, it's not about who does it first, but rather who does it when the conditions are ripe. What does this mean? Let's go back to the example of Uber. In fact, before Uber appeared, there was another startup company that also tried to help people book taxis with their phones. Their answer to the question why now was text messages. But the reality is that text messages alone are far from sufficient to support the development of mobile ride-hailing services. Such services require high-performance central processors, intuitive large touchscreens, and military-grade GPS accuracy. And these are precisely Uber's answer to the question why now. Let's take a look at YouTube. Before its appearance, there were actually dozens of video websites. However, at that time, due to the high cost of broadband and network storage, if the videos you posted on the internet went viral, you would have to pay tens of thousands of dollars in server fees to the video websites. However, in the era of YouTube, the bursting of the internet bubble led to a decrease in broadband costs, and the emergence of cloud computing led to a decrease in network storage costs. This allows YouTube to not charge video creators like its predecessors. Instead, it even shares advertising revenue from popular videos with the creators. This has given rise to a large amount of high-quality video content from the public, providing the driving force for YouTube's rapid rise. Fourth question, what special advantages do you have? A sharper way to express it would be, what makes you think you can do this project, or compared to those fierce competitors and followers, what unique advantages do you have? A somewhat sad reality is that many interviews end with this question. Because many entrepreneurs are unable to provide an answer when faced with this question. However, we must admit that in practice, if the founder possesses certain advantages, their startup company is indeed more likely to achieve great success in the future. For example, Google's two founders studied at Stanford University and knew many talented programmers skilled in algorithm writing. When Facebook was launched, Mark Zuckerberg was studying at Harvard University and was familiar with campus culture, enabling him and his friends to have a clear understanding of the potential market for online social platforms. Additionally, Bill Gates' mother, Mary Gates, served as the executive director of the United Way, and at that time, the CEO of IBM was a member of the board of directors. This provided an opportunity for IBM to later hire Microsoft to develop an operating system for their first-generation personal computers. So, if a person does not have special advantages in terms of family background, educational background, or personal skills, does that mean they cannot succeed in entrepreneurship? Of course not. But the author reminds us that the task of angel investors is not to water dreams or generate love, but to select, from the mixed and chaotic stream of projects, the one with the highest probability of becoming a unicorn. Okay, after asking the 4 questions above, we have a basic understanding of what this person wants to do, can do, and why. If you feel that he has passed the basic requirements, you can continue to ask him about the specific tactical details of his entrepreneurship, including business models, market strategies, team situations, and so on. Conclusion. Above is the key content that I want to share with you in this book. In addition to these, the book also includes some specific details at the operational level, as well as a checklist of questions that an angel investor may find useful when evaluating projects and founders. If you are interested, you can click on the original ebook at the end of the manuscript for further reading. From the theme of this book, its greatest value seems to lie in providing a practical guide for those who aspire to become angel investors or seek favor from angel investors. So, if we are not particularly interested in creating wealth, is it still necessary to understand and learn this set of angel investment principles? The answer is, it is very necessary. Although we may never become angel investors in our lifetime, evaluating whether someone will become the next Zuckerberg or if a company will become the next Facebook, each of us will at least evaluate one entrepreneurial project, and that is our own life. For example, how to find a higher potential return for the capital you have, such as time and manpower. Should it be a bed in Beijing, Shanghai, or Guangzhou, or a house in your hometown? How to determine the expansion potential of a company or an industry. If something fails, is it because the thing itself is not feasible or because of the person doing it or the current conditions? And so on. So, fundamentally speaking, this is actually a book that teaches us about decision-making and judgment. The author uses personal experiences to tell us that wise decision-making is more important than inefficient diligence, and accurate judgment is more valuable than a wealthy background. In the book, there is a paragraph that goes like this: starting a business or angel investing is like being placed in a large, pitch-black sports arena with a switch for a light. You grope around in the darkness, not knowing what you're doing, until you find this small switch and gently press it, suddenly illuminating everything in front of you. Think about it carefully. Doesn't this switch resemble the opportunities that each of us seeks in life? If value investors are good at being friends with time, then angel investors are good at dancing with opportunities. What they do, essentially, is identify opportunities. This is also an important inspiration we can get from angel investors, which is that for people with angel mindset, any era can be a golden age full of opportunities. Congratulations on finishing another book. Thank you for your support. Please subscribe to our Wisdom Planet audiobook channel. Like and share it with family and friends. Wisdom worth spreading and opening up a better future. Thank you, and see you again.